The AHA trap, why your breakthrough still bleeds you dry. Here's the hook you did not expect. Bro, the day you whisper, "I found it," is the day the market sharpens the knife. You stop worshiping indicators. Vow to own risk and feel that clean snap of clarity. Yet, your equity curve can still drip red ink like a slow leak after a rug pull. No sweat. Right. Except it is sweat. It is the kind you taste when your so-called awakening quietly turns into another belief system you hide behind. That's the sting of stage 3. You finally admit you cannot predict. But you start acting like your new humility predicts for you. You say no indicator, no system, no robot can print money on command. Good. Then you pivot to the mind and money management as if they, together, are a vending machine for consistency. That pivot sounds wise. It also hides a lazy assumption. You replaced one idol with another. Before, the blinking signal told you when to click. Now, the word discipline sits on the throne and you treat it like a guarantee. Hear that little clunk? That's the same dependency wearing a cleaner suit. You tell me one moving average with a sharp head on your shoulders and smart position. Sizing can make money. Sure, in certain regimes it can. But listen to the room tone. Tick, tick, tick. The market slips sideways, and your single-line gospel gets chopped into confetti. You call it variance. I call it the cost of insisting that simplicity equals immunity. You are not predicting, you say. But then you bind yourself to trade every valid signal as if the distribution cares about your vow. That's not stoicism. That is ritual. You read psychology. You underline the part about uncertainty. You nod so hard your neck pops. Then you tell yourself losses are not your fault because nobody can know the next 10 seconds, much less 20 minutes. I hear the relief in your voice, and I also hear the trap door opening. Not my fault can morph into not my responsibility faster than a stop loss can slice through your stomach. The market does not care about fault. It punishes sloppy execution and sloppy thinking. If you use uncertainty to absolve yourself, you're already bleeding. You lock onto a system that fits you and start feeling light, almost happy. Cute. The market loves that. Comfort is a magnet for complacency. You tell yourself the probability is on your side, and after a loser, the next one is statistically due to hit because your simple model always wins over time. Hear that? That is the small print you did not read. Over time is not a calendar. It is sample size under changing regimes, with slippage, spreads, liquidity pockets, and a fat-tailed distribution that laughs at your certainty. You swear you do not predict, but you imply it when you say the next trade has a higher chance. That is the gambler muttering under the breath you thought you trained out of yourself. You pivot to money management, leverage, account risk. At least that is real blood and bone. But even there, stage 3 has a smug edge. You treat risk like a magic shield instead of a throttle that can still ram you into a wall. You talk about accepting a risk you can tolerate each trade. And you act like that tolerance does not shift after a string of losers or a string of winners. It shifts. Your brain shifts. Your system does not live on paper. It lives inside your stress responses. When you say you will trade all signals, what you actually do is filter them through whatever fear or revenge is humming in your chest in that 10-minute. You call it process. The tape calls it human. And then that line about trading is just a game. Do the one thing. Follow all the signals. Yeah, I have heard that whistle in 1,000 accounts that died slowly. A game. Games have rules the referee enforces. Markets have rules the regime enforces. And the regime does not send you a memo before it flips. Your one-job mantra feels powerful because it is simple. But simplicity without conditional awareness is just performative discipline. It looks clean. It cuts deep. Stage 3 ends. You say, when you truly admit you cannot predict it. I will give you that. But admit it all the way. Admitting unpredictability is not the same as declaring immunity from it. If you really absorbed it, why does your language still lean on certainty? Crutches always wins. High probability. Trade every signal. Why do you talk like variance owes you a reversion while acting like volatility is a minor inconvenience? If the aha is real, why does your behavior still rhyme with stage 2 only now dressed in black t-shirt minimalism and a motivational audiobook? If the crown has changed heads but the throne is the same, what exactly did you find besides a cleaner illusion? You framed stage 3 as clarity. So let's put that clarity under a hard light and listen for the rattle. You swap prediction for probability and call it maturity. You pledge loyalty to a simple system, treat losses as statistical noise, and lean on money management like a crutch with chrome on it. Clink. Looks clean. But the moment you promise to trade every signal, you sneak prediction back in through the side door. That vow assumes today's signal distribution resembles yesterday's. It assumes your head, your hands, and your account balance behave like clockwork. Tick, tock. They don't. You say one moving average plus a disciplined mind plus sober position sizing can produce consistent gains. Hear the soft whir of convenience. A single line is not a compass. It is a lag. When the tape chops, you get minced. When the tape trends, you feel invincible and call it skill. You claim you are not predicting, but betting on that line is a forecast in costume. You're forecasting that regime persistence outpaces the slippage, the spread, and your own reactions. You think uncertainty has been accepted. Thanks for watching of the win more many-fied of rumens, always as the fatted of that can out of things for, yet you hang your equity on a structure that collapses the second volatility, shifts its mood. Crunch. You read psychology and learn that nobody can know the next 10 seconds or the next 20 minutes. Good medicine, bitter taste. But you sip it like syrup and miss the dosage notes. Not my fault slides into not my responsibility. And suddenly each loser is a shrug. No sweat. Except there is sweat, because responsibility is not about foreknowledge. It is about process quality under stress. When your aha becomes a hall pass, discipline turns into cosplay. You look calm while your decisions quietly bend to the fear of more pain, the itch for a bounce, the soft hum of revenge. That bend breaks accounts slowly. Drip, drip. You insist the next trade has a higher chance because your simple system always wins over time. There's the gambler's whisper again, and it is wearing a lab coat. The phrase over time gets tossed around like a charm, but time is not a cure. Sample size under changing conditions is. Your signals are not independent, your mindset is not stationary, and your risk distribution is not fixed. String enough losers together and your tolerable risk per trade mutates. Your rules look stable on paper while your nervous system edits them in real time. You do not trade every signal. You trade whatever slips through the filter of your current chemistry. And you call that consistency. You label trading a game and narrow your job to follow all signals. That simplicity feels pure. It is also selective blindness. Games have fixed rules and referees. Markets have shifting rules and no whistle. You may reject prediction, but you still rely on continuity. Continuity of liquidity, continuity of behavior, continuity of your own restraint. The tape deletes continuity without notice. Pop. Your model finds out the difference between probability on a whiteboard and expectancy in real life. The delta is slippage, spread, missed fills, stale reads, delayed exits, and a wrist that hesitates for one heartbeat too long. You talk leverage and account risk like you finally found the adult table. Fine. But leverage is not evil or holy. It is a multiplier of your execution. If your execution is clean, leverage accelerates good outcomes until it does not. If your execution is wobbly, leverage amplifies the wobble into a wobble you can hear in your breathing. You frame that risk as a comfortable fraction per trade, neatly capped. Cute. But risk is not a static slice. It is a path. Path risk compounds across sequences, and sequences get ugly exactly when your confidence is highest. Snap. You finish the stage by truly admitting you cannot predict. I am still listening for the part where your behavior matches that sentence. If unpredictability is real to you, why cling to the liturgy of always wins, high probability, and one job, follow signals? If humility is finally in your bloodstream, why treat variance like a storm? You can outsmile. When the axe falls, will your process hold up without the comfort blanket of overtime? Or is this just stage 2 dressed in new black? Sharper quotes, and a steady voice that cracks when the spreads widen and the clock ticks louder. So, what exactly breaks next? The system or the story you tell yourself about it? You want serious. Stage 3 hides systemic rot behind clean slogans. Fit the system to yourself. Sounds wise. Often it means fit it to your comfort. Comfort is not robustness. It is familiarity, pretending to be edge. You swapped indicator worship for identity worship, and you call that growth. You say the system fits your temperament, your schedule, your eyes on the chart. Cute. The market does not grade your temperament. It grades your exposure to regime shifts, noise clustering, and liquidity pockets. You like how your setup feels in your hands? The tape only cares how your setup bleeds when conditions mutate. That little click you hear, that is complacency buckling the seatbelt on your drawdown. You keep talking about probability like it is a badge. Where is calibration? If your mouth says, high chance, your journal should prove it across many hundreds of signals, scored and tracked with cold math that humiliates a loud mouth. That means error bands, not stickers, scoring curves, not slogans. Instead, I hear always wins over time and trade every signal. Do you model the longest losing run your setup can spit out when volatility clusters and spread yawns? Do you map the maximum pain path your equity can traverse without forcing a rule break? Or do you chant over time and hope the path is friendly? The path is rarely friendly. Expectancy on paper is a neat average. Expectancy in life is that average dragged through slippage, spread, missed fills, hesitation, and the hiss of a stop that slices because you were a heartbeat late. You promise to accept uncertainty. Then you reinstall certainty through the back door, a single moving average, a fixed fraction of risk per trade, a vow to take every alert like a metronome. That looks like discipline. It is rigidity in disguise. Volatility breathes. Your risk does not. Regimes rotate. Your rulebook prays they will not rotate while you are holding. When the tape shifts from orderly trend to mean reverting, chop. Your one-job ethic becomes a paper-cut factory. Snip, snip, snip. You call it noise. The account calls it death by 1,000 tiny reads that were never designed for that environment. If your process cannot flex, the market will flex you until something snaps. You read psychology and think awareness alone patches leaks. Awareness without mechanisms is theater. Where is your shock cord for state changes? Where is the kill switch when slippage widens, when spreads flare, when your fills lag by a heartbeat? You said you cannot know the next 10 seconds. True. Then why? Does your process pretend the next few hundred trades belong to one stationary world? Markets are not stationary. They are moody. Moody systems demand adaptive risk, not a laminated creed. If you will not encode adaptation, then you have not accepted uncertainty. You have decorated it and put it on a shelf. You lean on money management like it is a talisman. Fixed fraction risk sounds neat in a book and turns feral in the wild. Sequence risk makes a mockery of your smooth fraction. String a cluster of losers and the same fraction cuts deeper each time, because equity shrank, confidence thinned, and execution hesitated. You will not call it hesitation. You will call it prudence. And then you will under-risk the one outlier that actually pays the rent. The math does not care about your story. It cares about the path. The path delights in feeding you small stings until you dull the blade on winners and sharpen it on losers. That is how a sensible fraction becomes a quiet leak. You say the next trade has better odds because the system's probability always wins. That is not statistics. That is magical thinking wearing a lab coat. Independent trials are a fairy tale when your decision-making is coupled to the last outcome. One loser bleeds into the next via tiny nudges, slightly wider stop, slightly earlier exit, slightly rushed entry. Each slightly burns expectancy like slow acid. You do not see it because you record winners and losers, not the drift in the variables you actually control: entry quality, exit delay, slippage tolerance, hold discipline under heat. The log shows a loss. The truth shows a chain of micro-deviations that poison the odds you bragged about. You frame trading as a game where your one duty is follow signals. That creed dodges the hardest duty: monitor the conditions under which your signals even mean anything. Signals are conditional statements, not commandments. They assume liquidity that clears you, volatility bands that do not knife through your stop before the thesis is live, spreads that do not double, and a fill profile that resembles your backtest fantasy. Pull any one assumption and the floor groans. Pull two and the floor drops out. Thud. You say you accept unpredictability. Good. Then accept that signal validity is itself unpredictable, and the only antidote is surveillance and adaptation, not blind allegiance. You cap risk and recite leverage, ratios like you finally grew up. Maybe. But ratios do not neutralize path dependency. They only scale it. Positive expectancy can still bury you. If the road to the long run crosses a canyon of drawdown, your psychology cannot walk without breaking rules. You will call the break a judgment call. I call it the slip where edge goes to die. Stage 3 traders mistake restraint for edge, posture for process, and probability talk for probability work. They feel enlightened, then get blindsided by the first real regime turn that refuses to salute their tidy vows. So, when that clean narrative meets the market's moving target, which cracks first? Your comfort or your account? You want contrast. Here is the split screen. On the left, stage 3, as you tell it. 1, clean moving average, a calm mind, fixed risk, and a vow to take every signal. On the right, the market as it is, non-stationary, regime shifting, liquidity that evaporates, volatility that breathes like an animal in a cage. Your version hums like a metronome. Reality growls, lunges, then plays dead. Thud, then snap. Your script says enlightenment equals acceptance. I cannot predict. The tape answers with a trick. Acceptance is not protection. You accepted unpredictability, then built a routine that depends on continuity. You call that discipline. The market calls it wishful invariance. You think the vow to take every signal proves humility. In practice, it assumes the signal's meaning stays intact across time. Mood, spread, and fill quality. Spoiler, it doesn't pop. Your script says psychology is the edge now. You read the right lines, nod in the right places, and tell yourself losses are not your fault. The tape answers, responsibility is not about fault. It is about detection and response. If you learned uncertainty, where is your mechanism for detecting when your simple line stops mapping to intent? Where is the audible click that says context changed? Reading is not a mechanism. Awareness without triggers is theater. Quiet theater, until the first drawdown monologue. Your script says money management is king. Risk a comfortable fraction. Pick leverage like a grown-up, and you are set. The tape answers with path dependency. That comfortable fraction interacts with clustered losers, and the math you worship on a whiteboard melts into a path you cannot walk without flinching. One more loser, and your fraction feels heavier. One small winner, and you clip it early to feel safe. The spreadsheet never warned you about your hands. Your script says always wins over time. The tape answers with the longest losing run you never modeled because it feels impolite to imagine. You say probability. The tape asks for calibration. Where are your error bars? Where are the worst case sequences mapped out with slippage, spread, and delayed exits baked in? You say high chance. The tape asks, high compared to what? And verified how? That silence you hear, psst, is the gap between slogans and statistics. Your script says trading is a game with one job: follow signals. The tape answers with conditional validity. Signals are not commandments. They are if-then clauses with unspoken premises. If liquidity is present, if volatility sits inside the band, if the fill profile resembles your assumptions, pull one premise and your signal becomes noise wearing cologne. Pull two and it becomes a trap. Click. You followed the rule. The rule forgot the world. Your script says one moving average plus discipline equals peace. The tape answers with lag and whipsaw. Trend feels like skill. Chop exposes your costume. You call chop noise, as if labeling it reduces its teeth. Noise clusters. Clusters carve. Your tidy vow to take every alert turns into a razor that keeps shaving the same patch of equity until you are smooth and broke. Snip, snip, snip. Your script says you feel lighter, calmer, happy even. The tape answers with that cruel grin it saves for contentment. Comfort is a bad metric. Comfort correlates with familiar patterns, not with edge. You customized your system to your temperament and called it fit. The market grades fit to conditions, not to your feelings. When conditions swivel, your fit becomes a liability dressed as loyalty. Loyalty to a tool is romantic. The tape is not. Your script says you do not predict. The tape plays back your language like a courtroom recording. Trade every signal. High probability. Always wins over time. Each phrase smuggles prediction in the side pocket. You predict stationarity. You predict your own steadiness. You predict that the next sample belongs to the same bucket your backtest knows. You say humility. Your verbs say otherwise. Listen to them. They squeak. Your script says stage 3 ends when you admit you cannot forecast the next 10 seconds, not to mention 20 minutes. The tape nods. Then it checks whether your process can survive stretches of losses long enough to reach whatever overtime you worship. That is the hard contrast. Your enlightenment is a sentence. The market demands a structure. If the sentence stays and the structure never shows, what exactly are you relying on besides a cleaner story about randomness? So, if the slogans fall away, what replaces them that does not collapse? The second the regime turns, you want an escape hatch. Fine. Here is the crack in the wall that actually relates to your own script, not a fairy tale. Stage 3 should not be a pledge. It should be a specification. That "I cannot predict" line only has teeth when it becomes architecture. Not pretty slogans, mechanisms. Think of signals the way you quietly admitted the world works, as if, then clauses with unstated premises. Make those premises explicit in your own head, not as a checklist to obey, but as a context to verify. If the premise is regime continuity, you treat it like a fragile bridge, not a highway. If the premise is liquidity at the level you trade, you keep that in focus like a sniper keeps the target in the reticle. Click. No mysticism, just context in plain sight. Probability talk without calibration is karaoke. The alternative is a stance where high chance means documented error bands that embarrass your ego. Not for the internet. For you, if your setup says it wins more than it loses, the winning is a distribution, not a promise. The distribution has a longest route. Your overtime has a canyon. An honest Stage 3 treats that canyon as part of the plan, not as a surprise. It is not courage porn. It is math with consequences. You do not need cheerleading. You need awareness that sings off-key on purpose to remind you the tape will not harmonize. Your trade every signal line becomes trade every valid signal under intact premises, which is not the same sentence. The second sentence breathes. It respects that your signal's meaning degrades when volatility mood swings, when spreads double, when fills drag by half a beat. You are not dodging responsibility. You are finally carrying it. Responsibility here is not heroic. It is boring. It sounds like the premise is broken. The signal is demoted. No chant. No melodrama. Just a quiet demotion. Thud. Next. Risk is not a comfort blanket. It is a throttle that responds to terrain. A perspective that works with your own story treats fixed fraction as a default, not a religion. The default flexes when the road ices over. Not because fear flinched, but because the model you claim to respect just lost fidelity. Sequence risk is not a mood. It is a structural hazard. An adult read of Stage 3 acknowledges that your fraction interacts with drawdown path, and the path is the boss. When the path shows teeth, the throttle eases, not to save feelings, but to respect the error bars you said mattered. Smaller bite size. Same backbone. Losses are not my fault gets rewritten into fault is irrelevant, but process drift is mine. That rewrite cuts the shrugging. It places your attention on the micro shifts your log never catches when you are busy labeling outcomes. The alternative perspective values a boring sheet of process critical's entry quality, exit punctuality, slippage tolerance, fill decay more than the dopamine of counting wins. Boring is the point. The tape punishes noise. It rewards coherent boredom. Psychology does not sit on a throne in this version. It works in the engine room. Awareness is not a vibe. It is a trigger. The escape hatch lives in tripwires, the tiny if X then reduce Y clauses that you pretended were beneath you because they felt like rules, not wisdom. Funny how the wisdom you quoted evaporates when it needs a switch to ride on. Flip. If the spread doubles, the premise is dirty. If the fill lag expands, the timing thesis is suspect. If volatility bands expand beyond the calibration window you actually tested, trade every signal becomes trade fewer, on purpose. Not caution porn, just coherence. Your system fits me can survive if me means capacity for surveillance, not comfort. Fit becomes a burden you carry. Watch the assumptions. Measure the drift. Admit when the edge you believed in is now a rumor. That is not defeat. That is stage 3 without makeup. It looks quieter than the Enlightenment speech. It sounds like, the model is temporarily dumb. I will be clever by being smaller. You can almost hear the market yawn because there is nothing to hunt in that sentence. Good. Boredom is camouflage. And that trading is a game line. Keep it if the word game means a game of incomplete information where rules morph mid-play. In that reading, the job is not follow signals but validate premises. Then act. Signals become servants, not saints. Your AHA still stands, but now it sits on scaffolding made of calibration, context, and conditionality, not on a podium of faith. You can feel the difference in your breathing. Less chest beating, more steady exhale. No sweat said without sarcasm. Finally, so, if stage 3 is no longer a vow, but a spec, what happens when the next regime turn arrives and your old slogans have nothing left to cling to except the structure you either built or did not? You wanted synthesis without perfume. So here it is, stage 3 is the place where you finally say, I cannot predict. Then try to live with that sentence without hiding behind a shiny substitute. The original text nails the awakening and then drifts into a new comfort. One clean moving average. One vow to take every signal. One serene nod to money management. One airy shrug about fault. You call that growth. The tape calls it a costume change. The core engine in your story is not the indicator. It is the idea that acceptance plus routine equals consistency. Click. That is the soft click of a trap resetting. Because acceptance without calibration, routine without conditionality, and risk without path awareness still bleeds slow at first. Then, fast, when the regime flips while you are mid-stride. You said the difference lives inside the person. Fine. Then the person must stop outsourcing responsibility to slogans. The text says losses are not your fault because the future is opaque for 10 seconds and laughably opaque for 20 minutes. Fault is a courtroom word. Markets are a jurisdiction of process. In your version, not my fault hums like a lullaby that makes it easier to take the next signal without thinking about whether the premise is intact. In practice, responsibility means doing the ugly work your paragraph tiptoed around. Naming the hidden conditions that give a simple signal meaning, setting tripwires for when those conditions rot, and letting boredom, not bravado, keep you inside that scaffolding. Quiet dominance, not chest thumps. You said probability and money management are the new edge. The language in the text still leans on high chance, always wins over time, and trade every signal. That is prediction smuggled in plain sight. Probability that matters is measured, not narrated. Money management that matters is adaptive, not ornamental. The moment your voice implies the next trade is more likely after a loser, the gambler's whisper leaks through, even if you say you do not believe in streaks. The moment you pin your mood to a fixed fraction while your environment breathes like an animal. The fraction becomes a club, you swing at fog and then blame the fog for bruises. Thud. You said trading is just a game and your job is to follow. The text wants a clean job because clean jobs feel safe. Signals are not orders. They are if-then statements that burn value when the if fails and nobody bothered to notice. The script never shows the moment where a brutal chop regime demotes your trend signal from king to clerk. It never shows the structural humility that treats spreads, fills, and lag as living variables, not footnotes. It wraps the real, lesson uncertainty in a warm blanket and calls it peace. Peace with uncertainty is earned, not declared. Earned peace is boring to listen to and hard to fake, which is exactly why it works. You said stage 3 ends when you truly admit you cannot forecast. The admission is the doorway, not the room. The room is built from calibration that humiliates your adjectives, conditionality that refuses to worship continuity, and risk protocols that bend with sequences rather than snapping under them. In that room, your one moving average can still exist, not as an idol, but as a worker on a shift, clocking in when the premises hold, clocking out when they do not. In that room, trade every signal quietly becomes trade every qualified signal. And the qualification is not vibes. It is verified context. In that room, overtime is not an incantation. It is a canyon you have already measured, a drought you have already provisioned for, a path your psychology can actually walk without inventing judgment calls that conveniently rewrite the plan mid-burn. So, the bite is simple. Your aha is valid. The scaffolding around it is not. The text celebrates clarity and then pours that clarity into a das and mold shaped like comfort. That is why accounts die in stage 3, while the trader swears they finally got it. What actually gets got is the gap between acceptance as a sentence and acceptance as a structure. When the next regime bends the tape and your tidy creed reaches for familiar crutches, the only thing standing is whatever you quietly built that does not require faith to hold. No victory speech, no heroic vows, just a rig that keeps breathing when the room thins. If that picture lands heavy, good. Heavy is real. Light is what the market sells you right before it takes your lunch. If this breakdown hit like a gut punch, share it with your crew. Subscribe to Flow State Trading so the next time Stage 3 whispers comfort in your ear, you will have a sharper filter than slogans and a steadier hand than hope.